Welcome to Illuminati Silver. We tell you the truth about silver. Today is Thursday the 19th of November 2015 and we're covering the World Gold Council's report on gold demand trends and reactions to it. Last week, the World Gold Council issued its latest Demand Trend third quarter report, and this is what it said, and we quote, "Third quarter gold demand rose by 8% year-on-year, reaching a two-year high of 1,120.9 tons. Quarter 3 2015 was a period of two distinct halves. ETF outflows contributed to a price dip in July, which boosted consumer demand around the world. Subsequently, a positive shift in institutional investor attitudes led to modest ETF inflows in August and September, which pushed prices back up. Central banks bought another 175 tons in recognition of gold's diversification benefits, and after a long period of growth, the supply of gold from mine production contracted by 1% in the third quarter. So, global demand rose 8% year-over-year in quarter 3, while global investment demand rose 27%. On the retail side, gold coin and bar demand in the US rose 207%, its highest level in 5 years. December COMEX gold futures lost approximately 5% in quarter 3, hitting a high of $1,175.70 an ounce. Commenting on the findings, Juan Carlos Artigas, Director of Investment Research for the World Gold Council, told Kitco News, and we quote, "We do think there are good signals in the long run for the demand and for the balance of demand and supply in the market." Unquote. He also added, "Interestingly enough, central banks this quarter had a very strong performance. It was actually the second strongest net buying that has occurred." On the issue of supply, he stated, "The reality is that, from the supply side, it's not only mine production, it's a combination of mine production and recycling, and that overall has been fairly constrained. We expect mine production to taper off over the next year or two." The World Gold Council reported that central banks collectively were net buyers for the 19th consecutive quarter, with purchases by the official sector reaching 175 tons. Almost matching the record high of 179.5 tons in the third quarter of 2014. The gold price, however, continues to struggle under $1,100 per ounce as traders look at and examine inflation data for clues on the likelihood of Fed rate rises. In dollar terms, the gold price has fallen to a 5-year low on expectations the Federal Reserve will start to raise rates this year. However, many doubt the Fed will increase rates, with economic data suggesting the global economy is contracting, Japan is in recession, and the emerging markets are struggling to repay their US-denominated debts as commodities continue to fall. Gold is currently trading at $1,073 per ounce, having recovered slightly from its dip earlier to a 6-year low of $1,064. US inflation data, which showed consumer prices returning to growth and rising by 0.2% in the year to October, is another factor in gold's latest slump. The official figures were above analyst expectations, adding further weight to the argument that the Federal Reserve may decide to raise interest rates at its final meeting next month. According to the publication The Week, we quote, "Traders meanwhile see little chance of anything in the Fed minutes or elsewhere providing support for a significant upward movement in gold." In fact, a poll of investment bankers by the Wall Street Journal suggested the eventual increase in interest rates, whether it comes in December or next year, would hold gold at a lower price throughout next year. It added, "Gold has averaged $1,156 so far this year, and the 10 bankers surveyed reckon it will average $1,114 next year. Given that they also expect a recovery in the final months of the year, when further rate rises will have been thoroughly priced in, this could spark an initial 2016 move towards or even below $1,000 an ounce." So what is our view? The Gold Council predicts slightly rising demand and a small reduction in supply. Yet analysts are predicting further price falls. We can sum it up quite simply: the dollar and interest rates. Yes, gold has, in our opinion, now become a dollar and interest rate play. The basic fundamentals of the metal are reasonably straightforward. World political events seem to have only a temporary and small impact on prices. Supply is curbed for the foreseeable future, and so gold, as a monetary metal or investment, is now subject to the whim of the traders and confidence of the investors. As the dollar strengthens, the price of gold in dollars is likely to decline. Should the economy be seen to pick up and interest rates are raised, the opportunity cost of holding gold becomes greater or more expensive, and therefore its price will probably decline. If, however, we see no rising of interest rates and a falling dollar value, then this is likely to be bullish for gold. We believe that gold will fall close to or slightly below the $1,000 level. $950 is not impossible. However, it being then close to the cost of production or extraction for most firms, it then lends itself to be a cheap commodity to purchase for the medium to long term. Is there great risk at current levels? Well, that all depends on how much one is considering purchasing. In our view, the upside potential is greater than the downside risk, though we like to extract as much profit potential as we can before purchasing. We hope you have found this video helpful and informative, and would appreciate it if you would give it a thumb up, comment, and if you haven't already done so, please subscribe. Please also share this video on Twitter and follow us at Illuminati Silver. Disclaimer: Silver Illuminati owners come from a background of banking, international wealth management, and economics. Having now retired from these worlds, we're not qualified to give investment advice. Therefore, this and other productions must not be deemed to be giving such advice, and merely represent the personal views of its owners.